This is the Leadership in Insurance podcast, brought to you by FinPro Search Partners.
Insurance companies are businesses and they need to look for the long term and be sustainable.
We went from 0 to 1 and now it's going from 1 to 100.
Insurance as a concept, as a kind of service, is brilliant. The execution is what we're looking at now.
I think the companies that are going to succeed are the ones that are going to understand and master the art of intent.
When we talk about innovation, we lean too heavily to think about technology and we don't think about creating a culture of innovation.
I think innovation is essentially continuous improvement of existing processes and platforms and product.
Right? It's got to be easy. It's got to be seamless.
Good morning and welcome to the Leadership in Insurance podcast. I'm your host, Alex Bond, and I'm really fortunate today to be joined by Jonathan, who's founder and CEO of Fairmatic. Jonathan, it's good afternoon for us, isn't it? For the rules of the podcast, good morning. How are you?
I'm doing great, thank you, Alex.
Yeah, great. Well, look, thanks for joining me. We've been wrangling diaries to get this one to happen, but it's one I've been looking forward to. So thank you for joining me on here. Look, Fairmatic have been very visible. You've raised a lot of money, and there's been some really exciting growth over the 3 years. So I think a lot of people will know who you are, but it's always good to start with you introducing yourself and obviously the Fairmatic business, if you would.
Sure. So I'll start by a quick personal introduction. So I'm Jonathan. I'm the founder and CEO of Fairmatic. Prior to that, I was the co-founder and CEO of a company called ZenDrive, which is a mobile telematics company, which we recently sold to Intuit. Prior to that, I worked in technology. I was a very early employee on the Android team at Google, back when it was about 25 people. And then after scaling that up to about 1.5 billion users, I was recruited by Facebook to help them launch their mobile platform. Did that for a few years, and then after the IPO with Facebook, decided to go and start my first company, which was ZenDrive, with a mission of making roads safe using data analytics, in a way trying to fix some of the negative externalities that ubiquitous smartphones brought to the world, particularly with regards to road safety. And Fairmatic was born out of ZenDrive. So Fairmatic was a subsidiary of ZenDrive, a small MGA that we used as a sandbox to test the power of our risk models. So we collected about 200 billion miles over the life of ZenDrive and used those to build powerful mobile-based telematic risk models. These were the underlying IP and the power of what Fairmatic then took and built into what is now a thriving commercial auto insurer, again, an MGA. And so Fairmatic is a commercial auto MGA, very much focused on telematics. So all of our fleets are using our mobile telematic solutions. And these very powerful technologies allow us to differentiate between good and bad driving behavior, price fairly, and allow our customers to reduce their total cost of ownership and have an edge in the very competitive fleet space.
Brilliant, thank you. I wouldn't say it's a passion project for me, but it's a long-standing part of my career. I think I mentioned before I used to work in motor fleet a long time ago for a carrier, but it's a very broad church and range. So I think kind of interesting to see particularly where you focus and be good to sort of understand why that's the portion of the market that you do focus on within the fleet space.
Sure. So when we started again as a sandbox inside ZenDrive, we focused on light vehicle commercial auto for the simple reason that this was similar to personal line auto. And most of our clients at ZenDrive were large personal line insurers like Progressive Insurance and others. As we spun out Fairmatic, we looked at the entire commercial auto space and did a thorough analysis of which segments are most attractive and why. And we realized that the light vehicle commercial auto is more attractive, for us at least, than the heavy truck, long haul, heavy transportation space for several reasons. First of all, when you think about light vehicle versus large long haul trucking, the claim dynamics are quite different. So light vehicles typically have high frequency, low severity claims, meaning you have a lot of instances relatively small total verdict, whereas with trucks, you see more rare events, but very, very large exposure through severity. Those are typically called nuclear verdicts. And for a young company to focus on an area where claims are rare but can take you out of business seemed a little a little uncalculated, and we try to be very disciplined in where we choose risk. So that's the first reason. The second reason is that, as I mentioned, Fairmatic has always been very data-driven. So, we have more than 200 billion miles of data that we used for just the first version of our risk model. We're now running our fourth version of the risk model. And it was very important for us to be able to train machine learning algorithms and allow our actuaries and our statisticians to look at a lot of data and constantly iterate and improve on how we evaluate risk. And so if you are, again, looking at a problem space where there's a lot of high frequency instances, you can use them as a training data set and improve your algorithms and improve your risk model. So there was also kind of a strategic product or risk assessment insight in the segmentation we chose.
Does that filter down, particularly when you're looking at the US business, to like the state by state perspective as well? Because presumably the litigation states are different as well. So choosing kind of which states you can distribute in, there's always the desire to go nationwide, but is there a chance you restrict where you write business from a kind of state by state basis?
We try to be available pretty much nationwide. There are some states that we are, as you say, shying away from for those reasons. But even in states where we believe the litigation environment or the claims ecosystem is a difficult one, there are appropriate pricing mechanisms to protect your overall underwriting results. And so we can participate also in states where a normal insurer that doesn't have access to the kind of data that we have will find it quite risky or quite scary. But we're very, very picky about the risk that we bring on our books.
Yeah. Understood. I feel that's probably an interesting kind of segue slightly into we had a prior conversation and we sort of talked about some of the larger insurers and how they kind of tackle the space. You made this point about large insurers kind of tackling challenges like top down, but you're kind of like data up. I kind of wanted to understand, just to sort of go into what you meant by that, and probably it's related to the opportunities you just alluded to, but that top down versus kind of data up principle in the way that you do business.
Yeah, so as we expand, for instance, from segment to segment within commercial auto, or as we expand to new geographies, we try to bring data and insights from adjacent either segments or data sets. So I'll give you an example. If we started working at some point with artisan contractors, fleet size, 10 to 50, and then later on expanded to 50 to 500, we always started with something where we have an opportunity to learn, train our pricing and risk algorithms, and then expand from that. And that's kind of a basic product development principle that we have. My observation, what I've seen in how other large insurers typically work, is they make a decision to enter or to exit a state or a segment based on things that are a little orthogonal. For instance, like what's their overall loss ratio for the book, and do they have an appetite in growing the business? And then it's only a year or 2 or 3 years later that they can figure out whether the decision was correct. And so we're trying to be data-driven throughout, not just after the fact.
The data in the training, not just the post-match analysis to see how we've been performing. Yeah. This might be a stupid question, but I think my role sometimes is to ask the stupid question. I try not to, but sometimes it's the obvious one. But I think your background is particularly useful for this as well. Being in the kind of mobile first teams that you described in your work history. Why is kind of mobile just not dominated the kind of telematics space? Because and there was a movement to say like we had all this hardware, black box hardware, telematics has been around a long time, but definitely there was a sentiment that well, do we even need that anymore? Because everyone carries essentially a black box with them every day with mobile. Um, where is that kind of balance between sort of the hardware element and still kind of creating the kind of sensors, black box technology versus kind of mobile? And is there a trend in one direction, or have I kind of misunderstood the kind of application of the technology?
Well, I think there is a little bit of subtlety to this. There's an important segmentation to think about when you think about the adoption of telematics. So first of all, in personal auto, mobile is largely the winner. And I think, at least in the US, that's how most, UBI or telematics-based products is bought and sold. And there's good reasons for that. In commercial auto, I think the 10,000 feet view answer is that telematics as a pricing mechanism is actually not well adopted. So there aren't a lot of insurers that actually truly use telematics to understand driving behavior. They use it as a signal whether the fleet made some commitment to safety or not, and they give a flat discount. So that's one element. So in commercial, telematics is still very much in its infancy. The second element is that within commercial auto, there is a clear segmentation, the one we spoke about between long-haul trucking and light vehicles. And in long-haul trucking, there are two elements that actually make hardware quite sensible. The first one is that there's a mandate in the US for ELD, electronic logging devices. And so there is a kind of common unifier. And the telematics programs that do exist in trucking tend to use that data because it's widely available. So if a data logging device is already available, then why ask for an additional one? So that's one reason why within the long haul trucking of commercial auto, you see hardware dominate. The second is when you think about long haul trucking, because of the nuclear verdicts and because the cost of the vehicle and the cost of claims is so high, the cost of adding additional hardware-based telematics is relatively low. Whereas if you think about light vehicles, again, where the exposure is looking more like high frequency, low severity, and the cost of fixing or the cost of dealing with a claim is typically significantly lower, then amortizing the high cost of hardware for an entire fleet is more difficult. And so mobile is actually a very powerful and good grand unifier for light vehicles. When you look within light vehicles at further segmentation, I would say that the larger fleets, so fleets that have 100 plus vehicles, have often made an investment in telematics. And actually, Fairmatic has the capability to understand data coming from a variety of data sources outside of mobile. But that data, what we find, is not as powerful, not as predictive as what we get from mobile. So we use it currently as a secondary data source. The power of mobile in all segments and with all use cases is that in every car, there's at least one smartphone. And because of that ubiquity, software solutions that don't require additional hardware and operations and difficult compliance mechanisms are quite attractive.
It's quite interesting to see the difference between how you're using data and tools as opposed to kind of large insurers. Because as you started that explaining that to me, I was thinking about how cyber software is adopted with like insurance products. In that some are like more traditional carriers quite often saying, with the tick box, have you got cybersecurity software? Yes, or to buy this, you install this, and then we give you a discount across the piece. Whereas, if I think of like the more modern Insurtechs that are kind of on the cyberspace, resilience, etc., it's like live data feed on what you're doing, what your threat exposure is. So kind of similar to driving behavior.
Yeah, that's actually a very good analogy for how we look at data compared to how other players that basically ask, have you made some investment in safety telematics? And they give you a flat discount. Whereas we want to understand what's actually happening on the road. And the safer fleets are able to unlock significant better economics because of that.
And it's that looking at insurance as a better value proposition, isn't it? Like the serving of the customer. I think one of the challenges with insurance is not one of the biggest one is it's still a grudge purchase. No one really like desires it, but we've probably as an industry never kind of looked to sort of increase the customer experience, improve the customer experience, add that value, and that is exactly the kind of value that you would kind of look for a fleet.
That's right. So maybe to address that point, the value that fleets receive from us is not just financial, it's not just better economics, but also the full set of telematics tools, safety telematics tools that we provide, so they can see where the drivers are driving during the day and what are they doing, and coach them, and also predict what their insurance cost per mile, per driver, per month will be, and take business decisions based on that. So let's say you have a fleet of 10 drivers and Joe, who is a very reckless driver, you still want Joe to drive around, but maybe you'll send him on shorter trips, so you have fewer miles logged at the worst telematics score, whereas Nancy, who's a very good driver, you can send her on longer trips or have her more active while you coach Joe and try to improve his behavior.
Talking about drivers, I mean, I asked you about autonomous vehicles when we were on the call before. I think certainly there's kind of been a lack of nuance outside the industry. I'm sure you're deep within it, and I'm sure with other telematics providers and kind of fleet insurers, it's top of mind. Where are we on that journey, and I suppose how are you thinking about it from a future-proof perspective? Do you work with any autonomous fleets now? Are you kind of building a product set to that? Because obviously there's a unique set of challenges there from an insurance perspective.
So it is abundantly clear to me that autonomous vehicles are the future of mobility. What I think is going on and is happening with many parts of technology, to be honest, is that people underestimate what the long-term change is, but they overestimate what the short-term change is and how quickly it will arrive. And so the promise of autonomous vehicles has been around for a long time. And in some parts of the country, in the US, we actually see them on the road, but under very limited conditions. Specifically, when you think about commercial auto, the focus of the Teslas of the world and the Waymos of the world is not so much on that side of the market, but rather on the personal lines, on the individuals, the families. And so I think we're going to see that transformation happen first and impact first the personal line insurers and only later on the commercial line auto insurers. Now, having said that, I think there's a really important discussion, and one that we have on a periodic basis at the company, saying what is the timeline for commercial auto to arrive and how do you best prepare for that? And every now and then you might hear of a large insurance company that strikes some sort of a deal with Waymo or with Tesla or with Uber, helping them with their autonomous vehicle risk. But these are going back to the point we made earlier about kind of top-down risk-taking measures. These are clearly top-down rather than bottom-up or data-up approaches. And the way we look at this is, we're building the capabilities, the technology, the actuary capabilities, the product capabilities to understand driving behavior based on sensor data. Some of that sensor data is indeed measuring the individual, as in, is the individual distracted on their phone? And when you have an autonomous vehicle, there's no individual, there's no distracted phone use. But the other sensor signal that we're collecting is actually measuring the vehicle itself, right? The physics of the vehicle, is it speeding? Is it taking sharp turns? How is it interacting with other vehicles on the road? And that kind of analysis is universal and will be useful also in the world of autonomous vehicles. And so I believe that sometimes, potentially in the next 3 to 10 years, there's going to start, there are going to be some initiatives with autonomous vehicle and commercial auto. Again, it'll be very segmented both geographically and in terms of the type of commercial auto where it's actually useful. But when those are ready, I think insurers that can actually tap into the very rich sensor data pipe that those autonomous vehicles are creating. We're talking about, trillions of data points, and make sense of them and be able to assess the risk associated with them will have an edge on anyone else that's trying to enter the market top down. And top down, the risk would be based on assumptions and actuary manipulations, whereas bottom up, it will be based on statistics and signal data. And I believe in the medium term and the long term, it's the data-driven approach that will be most advantageous in that space.
Yeah, yeah. It's interesting as well that the autonomous vehicles gets kind of lumped together, and I think you articulated better than anyone I've spoken to about it's almost segmented between things like the sort of inner city distribution, the kind of long, the long state to state, city to city kind of delivery, and it gets lumped together, which is not necessarily helpful for this kind of like conversation.
Exactly.
Do you think that plays a part in how the regulators are able to kind of tackle these types of challenges? Because I have massive, like, it's easy to steam in on regulators and say that they're anti-innovation, but all these challenges that we're talking about when we're expert, you're an expert in this specific space and you know this specific space really well, they're trying to tackle these challenges at the same time without that kind of deep level of understanding. But is that kind of homogenous, autonomous lump that we talk about, is that being particularly unhelpful, do you think, from a regulatory standpoint?
I think so. Both from a risk perspective and from a kind of insurance product perspective, there are some very distinct exposures here. So if you think about long-haul trucking, most of the driving is happening on the highway, where autonomy is very powerful, appropriate, and can show up relatively quickly. But once you're off the highway, you can take that truck into a distribution center in a suburb or at the entrance to the city, at which point doing the inner city kind of light vehicle distribution is much more complex, both in terms of risk exposure and in terms of the insurance product that's necessary for that. And again, if you think about the segments that Fairmatic is playing at, we are at the segment that is least likely or is going to be disrupted through autonomy last rather than first. Whereas I think long-haul truckers are going to see the structure shift quite quickly. Now, I want to mention one thing that people that are very close to the industry know, but people in the insurance industry maybe are not aware of. Waymo had a very promising and successful trucking autonomy program. And I'm actually very good friends with the person who led that. That effort, unfortunately, was shut down for Waymo. They decided to double down and really focus on the robo-taxi. And there's various reasons. Some are political, some are kind of like prioritization and so on. But the fact that Google has decided to step away from it means that there are a few small startups that are chasing it. But as you'd imagine, for a startup to deal with regulatory and political challenges is very, very difficult. It's not enough to have a good product in order to be successful in autonomy. When you think about trucking, it's the truck driver is the number one employment category in the US. I believe there's 7 million truckers in the US. And so politically, trying to go and disrupt these things it's very, very difficult. And I'd say that if Google decided to narrow its bet there, then it's possible that even if the product will be ready, the time to market will be longer than most people expect.
Yeah, it's a really good point. And it kind of, we had someone on from Travelers that was part of their kind of policy and team. And one of my questions was like, why does that need to exist? But actually, when you look at these types of challenges, is exactly why it needs to exist, because particularly in the US, it's not that different in the UK, but certainly in the US, like the state and the government and kind of business kind of industrial complex it's so intertwined, but it's big business to big government, and being a startup in there, you've got limited ability to kind of influence at best. I wanted to ask you just a broader question about this being your, well, it's always it's sort of one continuous journey, because obviously Zen Drive and Fairmatic is a spin out from that, but just broadly, what did you learn on that kind of first journey, and how has that influenced, how you've approached building the Fairmatic business? I always want to know, well, what did you get horribly wrong that you're now saved a lot of time learning on this kind of second venture?
Wow, this can feel a full podcast. Just
Yeah, I'm
and I'm
sure.
curious, there's going to be a different answer depending on the audience. But I'll certainly admit that with ZenDrive, I had the privilege to learn from experience, and the best way to learn from experience is to make a lot of mistakes and iterate. And
Yeah.
so with Fairmatic, some of those experiences allowed me to try things differently. I'll give you just a couple of examples. One thing that worked really well for me with ZenDrive was to build the large engineering or R&D hub for ourselves in India. So I had a co-founder in India, and then that worked really well. There's amazing talent there, and if you have the right people leading the team there, you can really build great product. So that's something that we actually repeated with Fairmatic. One thing that I've done very differently with Fairmatic compared to ZenDrive is the Fairmatic fundraise journey was very different from that of ZenDrive. So ZenDrive took the normal path of, every year and a half going back to the VC community and fundraising and being dependent on the availability of relatively cheap venture capital dollars to continue supporting the growth of the business. With Fairmatic, we changed the strategy and we raised a lot of money up front, more than enough to get us to profitability. And the thinking behind it was that if instead of every year and a half, spending 6 months going down Sand Hill Road and trying to raise money, we could focus on the long-term viability of the product and spending more time with our distributors and our partners and our customers, then we would end up with a better outcome in the end. And so right now I have almost zero of my calories invested in spending time with investors, except for our own investors that we cherish. But I don't need to go and look for new funds. And that, for a founder who needs to do so many different jobs, if you just take one of the jobs that only the founder can do and take it off their plate, they can be much more focused on other things. And so that's an example of a lesson. The other lesson that I want to call out is one related to the mission and the ability of companies to execute on the mission. So ZenDrive's mission was to make roads safe using data and analytics. And the way we went about it, in other words, the strategy was building products and solutions for large enterprises and then having them execute and deploy those solutions and through that save lives on the road. And what I realized over a decade of doing that is that by depending on others, you slow down your path to impact on your mission to the speed at which those partners execute. And one thing that large insurance companies or large car makers or large telcos have is distribution and resources, but one thing that they don't have is a sense of urgency. And I really miss that. And so with Fairmatic, we have a much more direct path for our mission. Our mission is to make roads safe one fleet at a time. So it's still all about road safety, but because we are directly, through our product, incentivizing fleets, have better drivers, to coach drivers, to reward the best drivers, and overall to improve their safety, we have a much more direct impact on the mission, which is the reason for our existence. So that's a pretty big lesson that I'm happy for doing differently this time.
Yeah, it's a really strange timing. I was literally having a conversation this morning with a MGA in the cyberspace, but one of their frustrations about getting product to market was they don't have they didn't have their own in-house tech, so they're constantly working with tech partners, and exactly that conversation was had, was that you are at the mercy of their kind of level of development. And the partnership's got to be efficient and effective, and the reliance on outside individuals to kind of really kind of essentially roadmap your business success was quite frustrating, but also because exactly that, serve the customer in the most accurate way, you couldn't control it. So yeah, it's an interesting kind of parallel between a completely different market and your own. Jonathan, we're at time. So I wanted to say I've been looking forward to doing this, and it didn't disappoint. So thank you very much for being a guest on the Leadership and Insurance podcast.
Thank you so much, Alex, for having me. This was a lot of fun.
Great, thank you.